Tom Atteberry, you are a fan of asset-backed securities over at FPA New Income. So why do you like these securitized bonds, which caused a lot of trouble in the market about 5 or 6 years ago?
A couple of things about them that we like. One is the underlying loans get a very steady amortization stream. So the average life of these asset-backed securities is predictable. That's one thing. The other one is we can find loans that are backing critical assets, equipment, insurance premiums for companies, subprime auto, people need a car to get to work. So we find critical assets, we find assets we can value, and we can get a good loan to value from them. And we realize as rates rise and fall, the prepayment speeds on them don't change, so the average lives are fairly consistent.
Speaking of rates rising and falling, what's your outlook for rates from here on in? Because of the turbulence in the market, the 10-year is now down to 2.2%. It was as high as 2.5%, just kissed 2.5% not long ago. Where is it headed from here?
So I think you bring up an excellent point is you sort of, when you look at where you think rates are going to go, we've got two things that are vacillating back and forth. Sort of fundamentally, we've got people talking about, well, am I in an inflation environment? No, I'm in a deflationary environment. And that's making the 10-year do what, like you said, okay, you were at 2, now you're 2.5, and now you're sort of in the middle of that. And then you have the sort of periodic things of a Puerto Rico or a Greece or maybe the Ukraine as far as sovereign debt problems. And people flight to quality. And they go, okay, I need to find something where I know there's no credit risk, and it shows up in treasuries. And then you got the last piece is the Fed wanting to start an increase in rates on the Fed fund side. So you sort of mix all that together and you realize, all right, looking from here, they're rising. Do I think it's 50 basis points, 100? Not sure, but I know, okay, my next move is up. Now I'm just trying to figure out magnitude. And when I think about that, and I think about a 220 on a 10-year right now, and duration of maybe 9.5, I realize, okay, if it goes from 220 to 320, I'm going to lose 9.5% of my principal value. That's more than the coupon I'm going to make. So it just becomes a magnitude, and you realize the problem is fairly acute if that magnitude gets large. So we tend to look at it more that way than an absolute, okay, do I think it's going to be, and then fill in the X after that.
And with all that volatility out there, yours is a fund that has not lost money since 1984, I think.
Yes.
So is now a good time with the problems in Greece, with the problems in the Ukraine and China, to be in a fund like yours? If people want to play defense, are you raising your hand saying, come on over here?
Yes, I mean, I do think that we're a good place. Okay, this is a stable fund, stable return, low volatility. It's also set up in a fashion where you've got approximately 30% of the assets are going to amortize or mature between sort of March and the end of this year, and then another 25% in 2016, then another 15% in 2017. So it has this schedule of amortization with it that as you see these volatility points, as you pointed out, whether it's a Greece or some of these others, we're having money come back to us that we can then redeploy at what potentially would be a better return opportunity. So because of that low volatility and this money coming back, we think we're in a really good position to take advantage of uncertainty in the marketplace.
And because you're a defensive play, I want to hear from you, what keeps you up at night? Clearly there's a lot of variables swirling around the market right now, even the fact that the NYSE is not trading as we speak.
Yeah.
So what scares you?
So when I look at the marketplace in general, what's the most frightening? It's this illiquidity potential that is out there. We've had so much money flow into bond funds and ETFs. I mean, if you think back in 2008, that was roughly a $1 trillion market. Now it's about a $2.7, $2.8 trillion market. At the same time, you look at Wall Street's capital commitment to trading, and it's 50, 60, 70% less than it was. And you've got this mismatch. And you go, okay, as long as things are orderly, we're okay. But if some disorderly function starts to happen, we could have a very difficult market. And it's going to sweep up lots of things. So does it give us an opportunity? Yes. Have we protected ourselves enough against it? We think so. We've been successful in the past. But you know, I'm not always 100% sure, okay, something's going to happen I'm just not aware of. And it's going to happen because of this illiquidity issue that we see in the marketplace.
And then who would step in that juncture? Would it be the Fed? Is the Fed going to save us if that happens?
Let me put it this way. Keeping awake at night, I would be kept awake at night if I thought that's what the Fed was going to do. Because I actually think if they just keep our hands off, they're better, the world's better off. Yes, it will be difficult. But eventually investors will find value in that marketplace and they'll go in, step in, and buy things. I'm afraid if the Fed does it, you probably have more problems than it was worth. for them to do it.
Well, thanks a lot, Tom.
Thank you.
And thank you for watching The Street.